think we should move on to our next panel, and the moderator I'm very pleased to introduce is my colleague and my friend from the accounting group, Amal Shehata. And I know I said everything is online and you can look at bios, but Amal is a star teacher at Stern, and she teaches an extremely popular class in blockchain, but also classes in auditing and financial accounting. And the accounting issues surrounding crypto assets are definitely on her radar screen. So Amal, the floor is yours.
Thank you, April. And thank you to both of my colleagues, April and David, for your opening remarks. You have set the stage for what I am confident will be a robust discussion of the many questions surrounding crypto assets. And honestly, listening to David's commentary, it is time to get this conversation moving. As April mentioned, my name is Amal Shehata. I'm a faculty member here at NYU Stern in the Department of Accounting. I'm delighted to welcome all of you as we begin our morning roundtable discussion. You can continue to submit your questions through the Q&A feature, and we'll be checking those, and we're going to save time at the end and try to get to as many as possible. We are so fortunate to have 4 expert panelists who represent what we think are multiple dimensions of this conversation. Please join me in welcoming our panelists. We have Christine Botosan from the Financial Accounting Standards Board. We have Rob Jackson Jr., a former SEC commissioner and current NYU law professor. And by the way, Rob has to leave to teach one of his law classes a little later, so he'll be leaving a little early for our roundtable. We have Paul MacIntosh, a Big 4 advisory partner who serves as EY's financial services crypto leader. And last but not least, Suzanne Morsfield, global head of accounting solutions for Lukka, with former experience at the International Accounting Standards Board. And you can see more details in their bio that we've shared with everyone. Let's get started with the basics. As my colleague, Professor Klein mentioned, we are now seeing public companies like Tesla, MicroStrategy. They have billions of dollars of crypto assets on their balance sheet, and the accounting treatment classifies these assets right now as indefinite-lived intangible assets. So that means these assets have to be assessed for impairment and reduced to lower of cost or market. We've seen both of these companies recognize significant impairment losses on their Bitcoin holdings. And what happens is we end up having significant differences between the market value on these active trading exchanges versus what they are reporting on their balance sheets. We heard David's opinion that that treatment is nonsense. Let's turn to our panelists and get their perspectives. Suzanne, I'd like to start with you. If you could tell us, first of all, how you and Lukka are involved in this space, and then do you think the current accounting treatment provides a faithful representation of the company's position?
Sure, I'd be happy to start off on this not at all controversial subject. First, and thank you for letting me be involved in the panel. I'm really looking forward to it, hearing what everyone has to say. So Lukka is to start out with, Lukka is an accounting, or is a data and software company. So we don't give tax advice, we don't give accounting advice. What we do is capture and understand and analyze all manner of crypto transactions that are out there. And as part of what we offer to our customers then is various sort of data and analysis sort of tools and insight. But we also offer accounting and tax solutions. So to help them do their compliance and their reporting, which then leads me to one of the key things we've developed is one of the first, probably, I think it's the first fair market value for actively traded crypto so that we can help companies value their holdings and then calculate that infamous impairment number as well. So Our customers are the big exchanges that are out there, trading desks, CPA firms, audit firms, governments, miners. And so I say all that because we see a whole variety of the accounting issues, and we see a lot of what people are dealing with. And so I have views. We can handle all of it. Whichever direction the regulators, standard setters decide to go, we will help meet those needs. But I've developed views by watching what our clients are dealing with and being sort of up to my elbows in it every day. And I'm going to share my views, not necessarily speaking on behalf of my company here, but these are my views. So do I think this current model for those companies who currently are sort of being viewed as holding them as investments, and they're not investment companies, and they're not sort of subject to the fair market value sort of fluctuation accounting rules? I'll give you my punchline. Sorry, Christine, I'm not convinced this is a faithful representation. Having said that, let me back up and say, tremendous respect for what accounting standard setters do. I've been on that side of the table. The thing that's important for everyone to realize, and I know Christine will talk about this, is standards have to be based in something. There has to be a foundation. There's a conceptual framework that is relied on. Representational faithfulness is a piece of that story. I also think decision usefulness has to come into play. The amount, being able to help users of financial statements understand the amount, timing, uncertainty of future cash flows, also really important. And so when I think about whether this accounting and where we're at right now is the best, I have to say, again, I'm not convinced. And let me tell you a little bit more on why on that. And then obviously, I know other people will want to weigh in, but I understand how we got there. How we got there is, we look at the available list of assets and we look at crypto and we go, it's not that, it's not that, it's not that. Oh, here, we're in this indefinite life, intangible asset category. That looks pretty good. That looks like a pretty good fit. But then at that point, we hit this classification, sort of potential decision. But the context, the bigger context matters. And it matters because, and you have to look at what are the other indefinite life intangible assets that we're now living with, that crypto assets are living with. Well, a lot of times if you go to 10Ks and you look and you do a keyword search, it's brands, it's trademarks, it's things that are contributing to the operational cash flows of the company in a very direct way. It's not investments necessarily. Now, there can be examples of that, but the bigger sort of picture is often there. And then my sort of other kind of point I like to make, I call it my sort of where's Waldo point. And it comes from being a part of and seeing numerous presentations about crypto asset accounting and crypto asset developments out there, the transactions that are developing. And so slide 1 is the introduction to the topic and what we're going to do. Slide 2 is often, here's the current financial reporting. It's this indefinite life tangible asset. Here's how we got there. Here's the list. And then slide 3 starts into all the exciting things, all the exciting transactions and things that are going on out there. The things, Professor Yermak talked about, the lending, the borrowing, the buying things. And everyone gets excited. And before you know it, the slide deck's over, the presentation's over. And so my where's Waldo moment is at the end of this, because of my training, because of my background, I'm like, wait a minute, what happened to slide 2? Slide 2 was when we said this was an indefinite life intangible asset. And then we got all excited and talked about all these transactions. But what does it mean then? And here's the context I think is important. What does it mean when I am excitedly talking about all the hoodies we can buy with crypto, and I'm buying it with an indefinite life intangible asset? I'm buying it with a brand. What does that mean? What's the economics there? What's even the accounting meaning of that? And then we get excited about, I get to lend this crypto asset out and earn some interest on it. Okay, so I'm lending my trademark out. what does that mean? And I'm earning interest on it. Can we even do that? What's the accounting for that? What's the accounting meaning for that once we start doing that? So, and then of course, there's a whole discussion around the impairment model, because once you have an indefinite life intangible asset classification, there's an impairment model that goes with that. It travels together. And the impairment models throughout GAAP are different for different kinds of assets. And they're not always consistent with each other. And they don't, you could argue that maybe that whole part of accounting should be looked at one more time. But we bring that impairment model along that you already described. We have to ask, does that make sense? Does it make sense to impair a trademark that can no longer create sort of operational revenues or cash flows for you, or it's really impaired in its ability to do that, is one thing. To impair something that is actively traded, highly liquid, whose value can recover, is another thing. And so do those things all go together, is sort of how I ended up going, I'm not really sure they do. And obviously there's lots more we'll revisit as we continue on, but maybe I'll just leave it there.
Yeah, you brought up some excellent points, Susan. I love listening to your personal journey of going through this analysis. And let's throw the same question to Christine and really understand the standard setting perspective of this new asset class, which Suzanne has now given us some analogies to other indefinite-lived intangibles. Christine, can you tell us the same question? Do you think it's a fair representation? And what are those challenges in classifying new types of assets and thinking about, can you buy a hoodie with a brand or with a trademark? I'll turn it over to you, Christine.
Thanks, Emil. And the way you phrased that question, I do want to start with my disclaimer, because of course, these are my opinions. They are not the position of the Financial Accounting Standards Board, because of course, we only, set standards after extensive due process and deliberation. So I'm gonna change the question that you're asking me just a little bit. Because rather than focusing on faithful representation, I'd like to focus on the relevance of the information to the users of financial statements. And so the question that I'm going to answer for myself is the question of whether that cost plus impairment measurement model that is applied in many cases currently is providing relevant information to the users of financial statements. And my answer to that question is that it depends, because I believe that for any asset, the measurement model that provides relevant information to the users of financial statements is a function of how that asset produces expected future cash flows. So if we're talking about a crypto asset that is expected to produce market participant cash flows, so this would be the case where we have a crypto asset that is held for exchange in the open market. Well, then in that case, I believe that fair value measurement, provided it's a reliable fair value measurement, could provide relevant information. But if we're talking about a crypto asset that's expected to produce entity-specific expected cash flows, then fair value measurement would not provide relevant information because it captures a different cash flow stream. And in that case, historical cost approach could provide more relevant information. So that might be the case with a crypto asset that's held for use. If we're thinking about like a utility token that conveys a right to access goods or services. So again, from my personal perspective, the measurement model that provides relevant information is going to depend on the type of cash flows that an asset provides. That would be true whether we're talking about a crypto asset or really any other type of asset. Now, the second question that you asked me about was accounting challenges. Do you want me to go on to that one?
Yes, please.
All right. So there are a number of challenges from a standard setting perspective. First of all, crypto assets are a broad class of assets. I think Suzanne did a great job of sort of describing all of the different types of assets. and all of the different types of rights and obligations that those assets can convey. You know, to my knowledge, there is no legal or sort of commonly accepted definition of even the term crypto asset. So, you know, with all of that diversity and sort of lack of specificity around the population of assets, scoping a standard to ensure that the relevant measurement basis is applied to the right types of assets certainly comes with some challenges. And in some cases, the rights and obligations are not well defined, they're not well understood, and sometimes they have questionable enforceability. And so determining the correct accounting for something that is just difficult to really interpret what the underlying economics of the transaction are, well, that's certainly, you know, a more complicated undertaking in those sorts of circumstances. Then we also, I think, recognize that the marketplace is immature and it's evolving. Things are changing very rapidly. It is very hard to get ahead of something that is changing very rapidly. And there's the risk that standards that are written for the environment as it exists today could become obsolete tomorrow. And so we need to think about that, you know, in terms of standard setting as well. And then the last item I'll note is that if the measurement model we're discussing is fair value measurement allows for level 1, level 2, and level 3 inputs. And I think use of level 2 and level 3 inputs to value some crypto assets for which there is no level 1 input, that could be quite challenging, and it could raise questions about the reliability of the information and the quality of earnings that is produced when we get off of level 1 inputs in some cases. So hopefully that answered your question, Emily.
It does, and it leads me to another question, Christine. Do you think this is really one new type of asset, or could we really be talking about multiple types of assets that require different accounting treatment?
Yeah, I think the rights and obligations of different types of crypto assets. So, you know, we think in terms of there's payment tokens, utility tokens, security tokens, asset tokens. I mean, they all convey different rights and obligations. So I don't really see how that can be reconciled to viewing crypto assets as one class of assets. And as I said earlier, I don't see that there is only one measurement model that should apply in all cases, because ultimately it comes back to helping users predict future cash flows. And when those future cash flows are of a different nature, different types of measurement bases are going to provide relevant information.
All right, so let's turn our attention now to Paul. Paul, as the crypto leader for financial services, helping your clients comply with these rules, you must be very busy. You must have a lot of job security right now.
Yes, indeed.
We want to ask you that same question, but from the lens of your clients. How do you help them and advise them in how to comply with these rules? And what are you hearing from them?
Yeah, I think it's such a gray area. Like, there's no specific guidance for digital assets. And as everyone's alluded to and said, it falls into this indefinite lived intangible asset category. So in financial services, a lot of companies are looking to use these for trading assets, the exchanges, traditional banks, looking for, investment options for their customers. So there's a lot of chatter around, well, does that represent the economic value if we were to exit these positions at any point in time, right? So the impairment standard tells you, the indefinite lived intangible asset standard tells you that you write down these assets for impairment, but there's no write-up provision under that standard. So you can find yourself in a situation with such volatility in the market, not just intraday volatility, but volatility week to week, day to day, where these assets could potentially be undervalued and not represent the full economic value that you could exit these things at. And it's not just problematic at fair value, we're focusing on that, but some of these new products coming online, like crypto borrowing, crypto lending, because crypto assets are a non-financial asset under existing GAAP, well, that's how they're classified. You don't avail yourself of the derecognition or recognition criteria for financial assets where there's more asymmetrical accounting. So you can find yourself in potentially funny situations if you're doing things like crypto borrowing, crypto lending, where you would then recognize an asset if you're borrowing, for example, bring that onto your balance sheet as an intangible asset. But then at the same time, now you have an obligation to return that asset. So you have a non-financial liability, which then you have to potentially assess for an embedded derivative, and that embedded derivative might need to be bifurcated, and it creates a whole lot of other issues. And that does sound confusing and complex, and that's because it is, and that's some of the challenges that we come up with our clients. It's like, well, GAAP isn't clear. What do you apply here? What can you analogize to? And we try to fit it into the existing guidance, and sometimes it just doesn't make sense all the time economically. And then on top of that, it creates some operational challenges as well. So going back and assessing instruments for impairment every single day and making decisions as to when you write it down, or if you're doing crypto borrowing, crypto lending, can you value that derivative? Well, there's collateral involved. Does the collateral need to be on balance sheet or off balance sheet? And a lot of this isn't clear because a lot of these companies, their legal agreements, I think, like what the other participants said, aren't exactly clear as well. And how do you determine the legal rights and ownership and all of that? So it creates a very, very gray area. And I think a lot of the companies and the firms have coalesced around intangible assets, fair value. That's one of the simpler ones. But as we're seeing these new products come online, right, these financial services type products with crypto instead of securities, or lending instead of traditional fiat lending, crypto lending, it's a very gray area. And that's some of the challenges we deal with.
Okay, I'd like to, we're hearing so much about the uncertainty and trying to apply these rules. I'd like to shift our attention to the regulatory perspective, right? We're fortunate to have a former SEC commissioner. We have a standard setter. Let's think about the regulatory process. Rob, I'd like to turn to you. As a former SEC commissioner and a current law professor, what do you think the SEC's role is in this conversation? We heard Professor Yermak say the SEC is really behind the boat and doesn't understand what's going on.
Well, thanks so much, Emma. I'm delighted to have the chance to talk with this panel, and I'm by far the least interesting member of it, so I'll be brief. But thanks so much for hosting this. I'm proud to be here with my NYU colleagues, and especially my old and dear friend, April Klein. I think Paul, Christine, and Suzanne are asking the right questions, and I'm very proud that while I was on the commission, I'm proud of a lot of what we did, but I'm especially proud that incredibly, exceptionally thoughtful standard setters like Christine were appointed or reappointed while I was on the commission. Like me, Christine, a fellow academic who's gotten into the ring and tried to answer these hard questions, and I'm very proud of her work and that of her colleagues. I think we're asking the right questions. The real interesting question is, when's the market going to get an answer? And I think that's a fair question that practitioners of all kinds are asking on the law side and on the accounting side. I think Suzanne and Paul are wondering the answer to that question, and I think it's a fair thing to wonder about. And I think that Christine is going about it exactly the way I hope she would, which is asking, as a standard setter, what's the best way for us to deliver information that's relevant to investors, the ultimate users of financial statements. The way we've always answered that question, it's tried and true, and I think it's still the right way to approach this area, is how do these assets produce cash flows? And to the degree that they can be thought of as conveying firm-specific bases for cash flows and values, Christine's absolutely right. On that view, the existing approach makes sense. Here's the thing, though. I don't know about you all. I don't know a lot of folks who are buying and selling crypto for that reason. As an empirical matter, and this is a debatable empirical assertion I'll just make, and we can talk about it, not obvious to me that folks are doing it or managing that asset in the way they manage their brand. I mean, maybe you can trade it for hoodies. That's cool. I'd love a hoodie. It's not obvious to me that that's the basis on which people are buying and selling this stuff. I think instead what they're doing is they're trading it for market exchange value. And to the degree they're doing that, Christine is equally correct that the way we've treated that historically has been a fair market value approach. Here's the real challenge. If you're at the SEC, or if you're the chair I used to sit in, or if you're in the chair Christine sits in, when in the development of a market does it make sense for the law to step in and answer that question? And let's agree that it's not at time zero. It's not the day the market is born. Why? Because at that stage, we don't even really know what the value of the asset is or what its legal rights and obligations are. And we need the market to teach us a little bit about what it is and is going to be before we try to think about how to express those things to investors, and especially mandate how they'll be expressed to investors. Let's also agree it's not at time 30, right? It's not 30 years after the asset is first born, because by then we'd like to think the market has become sufficiently mature for people to understand value. And now we need some rules of the road as to how people are going to express that to each other to prohibit fraud and outlier behavior. The question is, when between time 0 and 30 should the regulator take that step? And the answer, I think, when it comes to crypto assets, is sometime soon. You know, when I was on the SEC, we didn't develop a systematic rule defining what a crypto asset is. We didn't approach it from the Administrative Procedure Act approach. And the reason is that that approach takes time, requires general setting of an ex ante rule before the fact, and wasn't suitable for the market we were observing at that time, frankly. From my point of view, the SEC's approach to APA rulemaking is the right approach. It's thoughtful, it's careful, it benefits from the input of commenters all across the marketplace, investors and issuers alike. But at the end of the day, it was not suitable for the crypto market we faced, which I felt was changing on a more or less daily basis. The question is, when will we get to a point in this market's maturity where the SEC can speak on that subject? And I hope and believe that the answer is soon. Just the other day, Chair Gensler explained in a congressional hearing that he thinks it's increasingly clear that the securities laws do apply to a number of widely traded crypto assets. I think he's right. And if that's his view, it may be that the SEC is getting ready to step in. And I want to say something about that, which is, boy, if I were Christine, and I'm just going to speculate here, Christine, if you want to correct me, please go right ahead. Boy, if I were Christine and I thought the SEC was getting ready to set some bounds around the law of these assets, I'd want to let them do that before I think through too much about exactly how those assets should be accounted for. Why? Because these legal questions are debatable. And the degree to which the SEC draws lines here and not there might inform the relevant information to investors and therefore the accounting standard setters' judgment about the best way to express that. That's not to say that the SEC has to go first, but I think that it might be healthy in this particular space. That's also true because let's all agree, these matters are not undisputed. It's not like people are coming to this with a fully open mind. There are people who are long, there are people who are short. They've got strong views that, in my experience, tend to align with their underlying position. And so you want to give them the extensive process they deserve when it comes to drawing these lines. And so my sense is that the regulators are getting ready to step in. I want to say one more thing about that, which is we can back up and ask ourselves as a community, should the regulators or Congress have stepped in beforehand? And I don't disagree with what David said. David, as usual, a very stimulating, thoughtful presentation. I don't think he's wrong that the laws that we have on the books are not an ideal fit for these assets. But I have to say, it would not be my view that we should wait for Congress. And I'll say, let me say why that is. It's not my impression that Congress is about to take a step in this area. And it would really be a shame and remiss of the regulators and standard setters if Congress, by waiting for Congress, we arrive to this space too late to help investors who are about to get hurt. I think it might be sensible for the regulators not to wait for Congress to take that step. If I thought that there were a bill moving forward that might provide the kind of new law that David was talking about, I might be a little more keen about that approach, but candidly, I think that's not in the offing. I don't have the impression that Congress is in the business of adopting lots of new laws at the moment. And for that reason, I think the market's need for guidance in this area, as Suzanne and Paul have explained, might require the SEC to go first. So in terms of process, I think that's where we're headed. I think it's where we should be headed. And I think it'll provide some help to standard setters like Christine, who are just trying to provide the information that investors, the users of financial statements really need.
Thank you, Rob. I am going to turn to Christine in a moment with some of the issues you've raised, but I know you have to leave to teach. So I want to throw one more question to your attention. And this relates to what David said as well. in terms of the US being behind, can we afford to wait? I guess that's one of the pressing questions I'd like to ask you, Rob. Can the SEC afford to wait while everyone else is moving forward globally?
You know, Emma, I have to say, this is an argument that is raised every time the SEC hasn't taken a step. I can't tell you how many times people came to my office and said, if you don't do this, IPOs will flee the United States for another jurisdiction. If you don't do this, ETFs will flee the United States for another jurisdiction. I have to tell you, I don't think I got through a workday on the SEC where someone didn't tell me that if I didn't do just what they said, not an inch different, capital would flee the United States. Here's my answer, Emma. I doubt it. And the reason is that for over a century, the United States have been the deepest, most liquid capital markets in the world. And the one reason they are is that the regulators have made sound judgments about when and how to intervene in markets. I think, Emma, the opportunity to raise capital in the United States is so valuable that the market will wait for the SEC to do the right thing. I don't think there's a serious risk of overseas markets developing in a way that would seriously threaten the United States' role in the development of the asset. However, I will say this is what worries me. The argument that other jurisdictions will do what I want before you will, so do it, never moved me. It doesn't move me today, and it didn't move me on the commission. Here's a better argument. The argument might be, Rob, if you don't take some steps to protect investors now, people are going to get hurt in overseas markets. US investors, in particular retail investors, might get hurt in markets that are less transparent or less liquid overseas. And that's something that you should give attention to. That's an argument that often made me think that we should get in the business of helping investors sooner rather than later. But candidly, Emil, it's an argument for enforcement action rather than systematic rulemaking, to the degree that you don't think there's systematic rulemaking. I could be wrong. I don't have the sense that the cryptocurrency community is super excited about the SEC's enforcement decisions in this area at the moment. So I would say in response to that argument that folks ought to be careful what they wish for.
You know, I'd like to take a question from the audience for you, Rob, that's come through.
Of course.
And this also relates to what David mentioned. We're using a lot of what David mentioned with regards to the regulators' real deep understanding of the technology. Can regulators effectively regulate if they don't really understand all of the nuances of this technology? So, for example, regulators who use digital currency or virtual currency interchangeably, or CBDC, do you think that they're prepared to really have to really tackle this?
So it's a great question, Emil, and the answer is that I think the number one organizational challenge of the SEC is people. After all, it's a person-driven organization, right? Anyone who's been to the office at 100 F Street knows it's a nice space, but the SEC protects and produces the deepest, most liquid capital markets in the world because of its people. And really what David's asking is, do they have the people to do this? My answer is yes. One of the folks that I worked with at the SEC that I most admired is Valerie Stepanek, who led our cryptocurrency unit for many years, a former engineer, extraordinary mind, and a very, very thoughtful interlocutor with markets. Anybody who's been in a meeting with her, I think, would agree about that. David is right to challenge regulators to get the human capital and the market knowledge that the SEC needs to do the work better. I will say this, Emma, that one of the things the SEC should balance carefully when it thinks about enforcement action or rulemaking is the likelihood of market participants to come into that building and explain the asset class to regulators when they're worried that their own words might someday be used against them in an enforcement action. I think one of the best arguments to counsel against that approach would be that you want market participants to feel comfortable. If I go in and explain to the regulators, here's what I see, here's what should worry you, and here's what shouldn't. That's when the SEC is doing its work best, when it's having those kinds of conversations. But my answer to David's challenge is yes. I think regulators are scaling up on that human capital need, and I think they'll continue to do so as long as their relationship with the market remains one where people feel comfortable sharing their honest views with the regulators, and that's really what's most important. I think all the noise about the SEC and the lawsuits it's chosen or hasn't chosen, I have to tell you, it's only really unhelpful in the following respect. If you believe, as David does, that the SEC needs to talk to this market to understand whether we're at T0 or at T30 or at T5, the moment where intervention is useful, then you need people to feel comfortable coming in and having that conversation. And I believe at the moment the market is still in that place, but that's an important part of the SEC's task in an evolving market like this one.
Thank you, Rob. And Christine, I'll turn back to you. There's a lot to unpack there. And let's start with, Rob mentioned, should the standard setters wait for the SEC so you have some legal background before responding? But let's back up a little bit. Right now, we understand the FASB is taking comments on the agenda consultation. This is one area where accounting is transcending politics. We recently saw several members of Congress across multiple parties, writing a letter to the FASB urging for some change in the accounting rules. We see it in the headlines, of course. I'm curious about the agenda setting process, what considerations go into that process as you look to define this asset class. So I'll turn that over to you.
Thanks, Emil. Yeah, we did issue an invitation to comment on our future agenda just past June. And the purpose of that is to seek public comment about the issues that we should consider adding to our agenda. During the first 2 quarters of 2020, our staff were engaged in a lot of outreach with stakeholders. We spoke to over 200 stakeholders, many of those being investors. I think a third of the people that we talked to were investors, and then preparers and practitioners, regulators. What came out of that outreach effort was the identification of over 40 topics that different stakeholders feel the FASB should consider for our agenda. Now, accounting for digital assets is one of those 40 topics that was identified, and it is included in that ITC that's currently out for public comment. Now, ultimately, once that comment period ends, and it ends September 22nd, so if folks are out there that are interested in participating in our process, I would encourage you to do so, and to do so by the 22nd. But ultimately, we're going to take all that feedback that we receive from the ITC and use that feedback as well as our agenda criteria to decide what topics, if any, should get added to our future agenda. I can't say what the outcome of that process is going to be because we haven't started analyzing the comment letter feedback yet. The period is still open, as I just said, but board deliberations will begin later this year. So I would just say stay tuned to see how that process unfolds. Now, in terms of what we consider, I referenced our agenda setting criteria. So first of all, anything that gets added or taken off of our agenda requires a majority vote of the board. And we have specific criteria because we need to be consistent in our evaluation of things that should be added to our agenda. We have specific criteria that we systematically go through. So there's 3 factors that we look at. First, is there an identifiable and sufficiently pervasive need to improve gap? That's the first thing. The second thing is whether there are technically feasible solutions and whether we can anticipate that the expected benefits of those solutions would exceed the cost of making the change. And then the third is whether the issue has an identifiable scope. So back in October of 2020, we went through those criteria with respect to agenda requests that we had received to add a project on crypto assets to our agenda. And at that time, we decided not to add a project because there was a lack of pervasiveness of holdings of crypto assets on entity balance sheets. Now, I've seen some figures recently The most recent figures that I have seen indicate that there are currently about 30 public companies that report investments in Bitcoin on their balance sheets. So, you know, the size of the group is growing. But, you know, at the end of the day, we will take the feedback that we get from the invitation to comment. We'll combine that with agenda setting criteria and our analysis of those criteria, and ultimately, you know, make a decision about which projects to add to our agenda. We don't have the resources to do all 40. You know, it will be a few projects that we'll be considering ultimately.
Okay, thank you. And I'd like to, you know, now that we've heard those criteria, I'd like to turn to our other panelists. I'll start with Suzanne. I know, Suzanne, you're in the process of creating your comments to share by the 20th. So the clock's ticking, audience. The 22nd is coming. And I'd like to ask both Suzanne and Paul, what do you think of those criteria? I know, Suzanne, when we talked about pervasiveness, you had some thoughts on that. Could you share with us your opinion?
Well, I think they're very valuable criteria. I do, you know, I think everybody out there gets, and I really do respect, limited resources, limited time, 40 projects. There has to be a way to sort through all of that in a way that's, you know, sort of ordered in a way that hits the most, you know, timely, pervasive, et cetera. So lots of support for the criteria. I think what I would suggest, and what I've seen from the crypto, sort of general crypto community, and I think the board will get some very good comment letters and very thoughtful ones. And there is a desire to help bring the pervasiveness sort of story a bit more fully, because everybody understands, I've done it as a staff member, done my keyword searches, done my counts, tried to figure out what's going on out there. And what I think from my perspective we could do is, I kind of call it two categories of evidence of pervasiveness: the dog that didn't bark category of evidence, and the dog that does bark right now. And there's some dogs barking right now, and there's ways to measure that, and there's ways to sort of look at that. And I think Christine hit on some of that, the trends. There's the sense of momentum and trends and change in all different ways that we measure that, not just the counts of the companies, but the volume of the transactions, the dollar amount of the transactions, the type of transactions, the momentum in sort of the players that are coming into this market. Who are they? They're very, very big, substantial names who are entering into this marketplace. There's momentum. There's now non-GAAP being created, quite by accident, I would say, but we have new non-GAAP measures. What are the trends in those? What are the dollar value of those? You know, the sense of, the other piece of it, I guess, the sense of, you know, getting at the non-public, the non-SEC reporting companies. And that's harder to do. And that's maybe where the crypto community could help quantify, because in the private company space, in the not-for-profit space, all of whom report under US GAAP in many, you know, in many instances, have needs and have a substantial part of this marketplace that we need to help capture. You know, I'd say probably some additions to the outreach, and this is the dog barking sort of part. You know, the accounting solutions providers for the crypto community are seeing things in broad and deep ways, and we could potentially help in terms of outreach. The dog that didn't bark part of the story, the gaps in GAAP that are where we're currently sitting, because we all still have to account for this right now. We still have to report for this. And it hits on something Christine mentioned in terms of relevant, useful, reliable information, all of that part of it. You won't always pick up in counting the firms. It is going to be, there's issues that aren't being brought to attention, that the information isn't being provided, that is harder to get your arm around because it's the dog that didn't, arms around because it's the dog that didn't bark. But again, I think in some of the comment letters that you're going to receive from the community, you'll get a sense, more of a sense of that. And then at the risk of, you know, annoying Robert, I will say that this notion about there's IPO ready companies out there that are grappling with the current accounting model. And they are either, the time is ticking while they're trying to grapple with it and deal with getting their 3 years of financial statements under indefinite lived intangible asset sort of classification. That's a piece of the story that is worth trying to get arms around. So there's just some ideas around other ways to think about pervasiveness that the community, I think, is happy to help with as well.
And Paul, as you think about this question, I'm curious if your clients in this space are trying to get their voice heard with the standard setter. Is there any collaboration, and how are they trying to influence the ultimate rules that come out?
Yeah, no, I'm glad Suzanne brought it up, and that was the point I was going to raise. If you look at the market, it's the pre-IPO market. A lot of these companies may or are trying to go public in the next 18 months, 2 years, 3 years. So there's a lot of private companies trying to apply GAAP now. There's a lot of private companies doing very, very complex kind of financial services products, crypto borrowing, crypto lending, stable coin issuance, and then the gap is very, very gray there. And they'll reach a stalemate when they do their S1 or their S4 if they're going through a SPAC merger and they try to file with the SEC and they're presenting a certain view of accounting, which hasn't been opined on, or there's no clear guidance on. And I think that's some of the challenges and concerns that they have. I think the industry as a whole is relatively immature, meaning that the crypto community has not really coalesced and come to the standard setters or regulators as a joint body. There is a lot of movement out there to do that. A lot of the companies I deal with are very eager to do that. They don't know the right way to go about it sometimes, but I think there is a genuine desire to coalesce as an industry and come to the regulators and standard setters. So I think, I don't think companies necessarily want more regulation in terms of being burdensome or negatively impacting the market. What they want is clarity, right? So not against regulation either. So I think everyone recognizes the need for regulation, consumer protection, consumer confidence, transparency in reporting, but they want to understand what the rules are, right? Who they apply to, are they being applied consistently to everybody? And that was some of the commentary in the press recently as well. And to the extent there needs to be any new regulations or current regulations are not clear, I think there really is a desire to work with the regulators and the standard setters to come up with a common sense solution. So given the uncertainty in this space, first from a standard setting perspective, regulatory perspective, right, I think this may be causing some of the hesitancy in mainstream adoption as well. And I think that's what we hear from our clients in the boardroom. It's okay, well, if there's some more clarity around this, we're willing to work with it. But it's taking that first step, and I'm not sure a lot of folks realize, what that first step might be and how to work with the regulators and standard setters. But I think your point, Suzanne, was very good. That was one I was going to make. Let's not just look at the current issuers, the current registrants, but what might be coming down in the next 2-3 years, and what are these companies doing, and what are they looking to do? And I think the challenge Christine and others have, it's so dynamic, so evolving. If you look at this space 3 years ago, right, it is exponentially different to what it is today. And that's always going to be the challenge, because I think it's going to continually evolve, and the standard setters and regulators are always probably going to need to catch up to a certain extent, but that's just the evolution of the market.
Yeah, it'll probably evolve even after we get off this call. I think we'll probably see
changes. Look at NFTs, Amal. I mean, they didn't exist, in the vernacular 18 months ago, and now it's the hot topic. So fast forward 12 months, if we had the same conference in 12 months' time, who knows what we're going to be talking about in 12 months' time. That's the rate and pace of change. It's just crazy.
Yeah, it is. Well, Christine, one question then, as I'm hearing Suzanne and Paul really encourage the FASB to think about that broader population, one question I have for you in terms of the standard setting process is, we have seen with important changes to standards like revenue recognition and lease accounting, it can often take many, many, many years. Do you think that the rules for this particular class of assets, should the process be accelerated so we don't wait 10 years?
Yeah, that's a great question, Emil. And before I respond to that, I did just want to respond a little bit to what Suzanne and Paul were saying, because their points are well taken. And we have had conversations and continue to have conversations with the industry. I know Suzanne's aware of a recent series of meetings that we've been having, because our process is only as good as the input that we get. And so we are constantly seeking that input from all of the different, parties that are involved in this ecosystem. And it is a fine balance. It's a fine balance between the risks of getting ahead of a market and having the accounting sort of, start to affect how the market is developed because the accounting is ahead of the market, but then getting also too far behind the market. I think that's what Rob was talking about earlier in his remarks. And so it is just trying to find that balance. But I know all of the organization is really looking forward to that feedback that we're going to get through the ITC. Now, in response to your specific question, Amal, about the amount of time that it takes to complete a project, that amount of time really depends on how broad the project is. So let's just think about, some of the requests that we've gotten with respect to crypto assets. There are some stakeholders that would just like us to undertake a narrow project that would allow entities to apply a fair value option to, a narrowly defined set of digital assets if fair value is readily determinable. Now, even that project, the current definition of readily determinable probably wouldn't get them where they would like to be. So that would, be part of that project. There are other stakeholders that would like us to undertake a broader project to improve overall accounting for all non-financial assets, including digital assets, because, there are some indefinite-lived intangible assets that are not digital assets that could be held for investment purposes, and the same sorts of criticisms or concerns about the accounting could be leveled in those areas as well. In addition, if we did take on a project, there are a number of other project scoping issues that we would have to determine. So should it focus on the holder only? Should it focus on the issuer? Should it focus on both parties? Should it involve amending the existing standards, or should we have a clean sheet of paper approach? Should it focus narrowly on certain types of crypto assets, such as payment tokens, or should it include all different types of crypto assets? That's probably not all of the questions that the staff would ultimately have to consider in scoping the project. And I don't know what the answers to those questions are, but I do know that if a project were added, the size of the project is going to influence the amount of time that it takes. That time, I think, it's important to not short circuit the process because due process is such a critically important part of what we do, and getting that input and that feedback to try to get it right the first time is so critically important. So we'll just have to, we'd have to see how big of a project it is if a project is taken on.
All right, thank you. So we're going to turn to Q&A in just a minute, but before we do, I'd like to ask all of our panelists the same question as far as what keeps you up at night thinking about this topic that is so relevant and so moving so quickly. So why don't we start with Suzanne? We'll start with you, and then we'll go to Paul, and then to Christine. Give Christine a little break for her.
Well, I think I would say, as from Lukka's perspective, whatever direction the standard setters and regulators go, I started out saying that at the beginning, but I say that now, like, we can handle it. So that part doesn't keep me up at night, at all. Like, will it be a direction that we can't handle? Utterly confident in that. What does is what is exactly what, you brought up and Christine had to speak to, because of knowing that the size of the project will so much affect the timing. So by, you can end up with a really long project. And so, the uncertainty in the meantime, the fact that we all have to account for things in the meantime that in many cases don't seem to make, good economic or accounting meaning sense. I would say, I think, in an ideal world, looking for, this is a bigger topic. And so not to sort of downplay that, but if there's a larger project or something that's embedded in another larger topic like non-financial assets and investing of those, but targeted smaller projects at the same time that can move some things forward, highly liquid, actively traded on recognizable markets. One of our products literally does that, identifies the high quality exchanges with market integrity and all that. So they're highly liquid, really observable prices. Maybe we could start with a targeted project that kind of looks at those. And, it's a whole other, potential conference, or presentation to talk about as Christine mentioned, the level 1, 2, 3 sort of issues around fair valuing these things, but it's a worthwhile thing to talk about. And it's something we think about every single day. So the uncertainty, and maybe in the meantime, some smaller targeted projects, and the larger project that could take a long time, making sure we can sort of get something solved in the shorter term.
Yeah, I wouldn't say anything keeps me up at night. I think I'm very excited about this space. I'm excited we're on the precipice of a new financial services industry, disruptive technology, new ways of doing business that can have a positive effect on the entire ecosystem. I think, similar to Suzanne, I think that the lack of certainty in existing guidelines, regulations, that's required to protect consumers. Are they evolving enough in this dynamic environment? Could they actually slow the rate of mainstream adoption? Potentially, that's the only real concern I have. But if you look at decentralized finance, which was spoken about earlier, right? That's not just limited to improving what the existing financial infrastructure is. It's bringing new types of financial services products, opening up the doors to financial services to folks who previously didn't have that, right? So, for example, peer-to-peer lending, that brings benefits to users. Folks now have more things to do with their savings. They can, they can manage their savings in different ways through decentralized finance. The Ethereum boom a few years ago opened up the world to tokenization. So now you can use smart contract capabilities to issue new crypto tokens, over anything, oil, gas, property, residential property, commercial property. So that this kind of new products and services are super exciting. So the only concern we have is, are the standards setting the regulatory environment, is that keeping pace with the rate of market change? But otherwise, fantastic what's happening in this space.
Okay, we'll turn it over to you, Christine. What keeps you up at night?
So one thing that keeps me up at night actually is a quote from an article that was published in May of 2008 after the last financial crisis. So I'm just going to read the quote. It says, as credit markets froze and stocks gyrated, investors and pundits naturally looked for someone or something to blame. Fair value accounting quickly emerged as the problem. So, if we look over the last 12 months, ended sort of mid-August, the return to Bitcoin was 325%. The return to Ethereum was almost 750%. Everyone loves fair value accounting when prices are going up, and they're going up rapidly. But when markets fall, then it seems that it's the accountants who always catch the blame. So to be frank, that is something that I worry about.
Yes, of course. That does tend to be the case, looking for blame. All right, let's take a look at we have a few minutes remaining. We'd like to take a look at a few of the questions we're getting from our audience. One question that's coming through has to do with, we are seeing a proliferation of countries looking to establish digital versions of their fiat currencies, CBDCs, central bank digital currencies. Do you think, and I'm not sure if one of you in particular wants to take this, but what are the financial reporting and tax implications of the establishment of these CBDCs around the world? Anybody want to jump on that one?
Well, I won't try to speak to the tax implications. I think the financial reporting implications is that we do, at least for US GAAP, have a master glossary definition of what is a cash equivalent. And so from a financial reporting perspective, I think that a coin that is backed by that is a fiat currency, that guidance would be the area that someone would need to go to determine whether or not it meets the definition of a cash equivalent.
Another question that I see coming through has to do with, in the meantime, while we're waiting for the standards to review and consider, is it possible to clarify some of our existing standards to better accommodate all the varying types of crypto assets? So for example, some crypto assets could be considered financial instruments if the claim against an issuer requirement could be viewing a decentralized blockchain as an issuer, whereas some crypto could be viewed as a commodity where we already have some movement in that space. So is it possible to look at our standards and think about the underlying intention and purpose and maybe apply the rules differently? And I think, Christine, this would probably be yours as well.
Well, I think when I was responding to the question about the size of the project, if one were taken on, part of the scoping decision would be, do you need a clean sheet of paper approach, or do you just tweak existing standards? So I think that, if we got to the point of having a project added to the agenda, part of the decision making that would have to take place is that the approach that we want to take? What are the risks and benefits from a standard setting perspective of that type of an approach? Part of the question would be the scoping. And so if you start, we start changing guidance to accommodate this, does that pull a thread that then affects that in ways that we don't intend to? So, so I would say that's certainly a possible approach, and would be one that would be in the mix of things that we would consider if we got to the point of adding a project.
So I think those are great points, because you do want to be really thoughtful about this. And as you look across, the existing gap and try to look for, do I patch this here and that there and undo this and tweak that, it does require thought. By the same token, no pun intended, there's likely a lot of analogs in existing transactions with the crypto version of that. And I think, there's this interesting sort of discussion paper that the Basel committee put out and had, open for comment. And yes, it's in a banking environment and it's slightly different, but they were grappling with the crypto assets classification question. And they had these two principles that I thought were really interesting. One is same risk, same activity, same treatment. And I thought that was a really sort of interesting and potentially helpful thing for all of us as we grapple with this. Their second principle was, let's be technology neutral. So if it's the same central transaction or asset, but we've wrapped it in a different technology so that it's being delivered slightly differently, it's being delivered in a different way or executed in a different way. The key thing is to go back to this same risk, same activity, same treatment. I'll read a quote from there because, again, I don't want to misquote, but they say a crypto asset that provides equivalent economic functions and poses the same risks compared with a traditional asset should be subject to the same requirements as the traditional asset. And it's just a sort of interesting thing to maybe help feed into this discussion when we're trying to think about where could we make some of those targeted, potential changes.
Yeah, so I think that's a really good point, Suzanne. And I like I said, I could see that being amongst the possible approaches that we might take. The one thing though, if we you know, if we think about what I was saying earlier about readily determinable fair value, well, you know, one could make the argument that we already have guidance there. Doesn't matter if it's crypto or it's, you know, a different type of security, that guidance is there, it should be applied. Now, the problem that we're going to hear though from the players in this marketplace is, well, you know, our markets aren't as well developed as the types of markets that might be described in that definition. And so then it requires tweaking that definition to allow it to be applied now in a crypto space. But there are other assets that are being traded that are using that same definition. And, you know, those changes that we make could have then knock-on effects for things that we don't intend to have. So, you know this because you were in standard setting yourself. It's certainly a viable approach and one to consider, and ultimately might be the right approach. I don't know. You know, we'll have to wait and see where we end up. But it's not always as straightforward as, well, you take the guidance, you tweak it, and you know, it just impacts the thing you want it to impact and doesn't end up impacting other things. And those are just some of the things that we'll take into consideration, you know, as time goes on.
And Paul, I'm curious around this same topic. Are you seeing your clients looking for this kind of customized approach? Which, by the way, when looking at that bipartisan letter from the Congress representatives, that's what they were recommending in the letter that was in May, saying, let's look at the underlying intention and apply different rules depending on that intention. Paul, what have you been seeing?
Yeah, I think it's a great point Suzanne raised. What is the risk and what is the key activity? So some of our clients try to analogize their business to other business models existing in the regulatory framework. So, for example, do crypto exchanges operate for all intents and purposes like a broker-dealer? And if so, should they apply then broker-dealer type accounting, which does then allow fair value? The challenge with adopting or changing all of the different standards, there's so many that impact crypto now, right? It's not just intangible asset accounting, you've got, you know, non-monetary assets, you've got even the revenue recognition standard. There's just so many standards which impact crypto. Can you meaningfully go and modify each one? And I think, like Christine said, when you start going that route, then you'll find there are other strings that you pull and other things pop out, and all of a sudden you've got this myriad of things that you need to change in a different framework. But bottom line is everyone's just looking for clarity in some way, shape, or form. So there's been some very good AICPA practice guides out there on how you do things, which have been very illuminating for our clients. Those are the kind of things that they're looking for. I mean, ultimately, the definitive guidance coming from the FASB is the golden chalice here, but everyone recognizes how nuanced and how complex this is. But folks just want some clarity and consistency. And I think that's the concern for a lot of these private companies who are looking to go public soon. If and when they get to the SEC, are the SEC going to provide a different view or push back on certain things for ways of accounting? And then when you do that, of course, there are huge operational impacts, right? If you go down a certain path and you think this is the way it's getting done, and Suzanne will attest to this with some of her clients, the data gathering, the data management to account for it in the way you think is right, and then for someone to turn around and say, hey, no, this is incorrect, or we've taken a different view on this, it causes a lot of rework at the back end and operational challenges and time and money. And that's our clients' main concern.
Okay, I think we have time. Okay, Suzanne, please go ahead. Go ahead.
It'll be really quick. So,
yeah, go for it.
I sort of want to pitch for like a formal working group, you know, that the FASB, you know, sort of sets up, which you've done before, and some of these bigger sort of topics that have a lot of moving parts that need some, you know, insight and education from people really in the field. And so I just sort of thought I'd throw that out there as an idea, you know, given, you know, what we're all talking about.
So just thinking, I'm going to kind of paraphrase one of the questions I'm seeing here, and think about with the existing rule as it is, which is going to persist for at least some time, we know, thinking about the potential for earnings management and potential manipulation, a company being able to time the sale of their Bitcoin, for example, to recognize a gain or a loss or whatever they need for that period. And also the question I see from the audience is, what about how to properly value and classify a crypto asset when that valuation could be self-serving. For example, if the issuer has a self-interest in growth, distribution, and wide acceptance of whatever variety of that crypto asset is. Are any concerns or investor protection that we want to think about from that perspective as we apply this existing rule?
I can, speak to one piece of it, Emma, and I'm sure everyone else, will want to chime in. But from a valuation perspective, this is where something, like what Lukka does is really important. We're a third-party source of valuation. We're AICPA SOC 1, SOC 2, Type 2 certified, which means we're heavily audited, for our processes. And, we're able to create about, not create out of thin air, but it's published in a peer-reviewed journal, our method for actively traded crypto assets coming to a really, really solidly defined and determined valuation. So if an entity, is using a third party and relying on that, relying on an audit, a SOC, audited company's valuation service, that can really add comfort to the valuation. So it's not just coming, out of thin air. It is a really, and we're very transparent about our method, and it's meant to be aligned with US GAAP, aligned with IFRS. And it's just something for, for everyone to consider and see if that helps bring some comfort then to this particular issue. So.
Yeah, and a lot of the larger coins are very, very liquid at the moment. So Bitcoin, Ethereum, Litecoin, right? There's a lot of market data out there across the various crypto exchanges. The challenge you get into is with the more lower down the ladder altcoins, right, where there isn't much market liquidity, and are they being pumped up? And those are fundamental questions. But definitely for like the larger coins, your top 10s, there's a lot of market data out there. The similar to what banks do, the exchanges sort of reconcile that against each other. There's not as much arbitrage opportunities there was a couple of years ago. If you look a couple of years ago, there was distinct and stark differences between prices of these assets across various exchanges. As the market has grown and become more mature, it's sort of meeting that definition under the fair value standard. Is it an orderly and active market? And then can we sort of get there, right? That's the fundamental question. And perhaps for some of the larger coins, you can make that argument.
Okay, so any thoughts? One last question for Christine. I know we're running out of time. Just curious, looking at the regulator and the standard setter, are there any conversations between those two entities at this time that you can share with us? How are you interacting, as I'm sure you're both being bombarded with commentary and advocates on different sides of this?
Yeah, so we have a very good working relationship with the SEC, also the PCAOB. All parts of the system get impacted when accounting standards change. So there are ongoing conversations that happen at the staff level, at the leadership level, and certainly, we have observers from those organizations that attend various advisory committee meetings that we have where we discuss these issues, and so they provide input. So yeah, we don't work in a silo because the system doesn't operate in silos.
Well, you have all brought up so many good points. Suzanne, you brought up the point of the SOC 1 and SOC 2 and the audit function. That's a whole different conference of all of these assets floating around here, many of whom are not audited and not within the jurisdiction. But unfortunately, we have run out of time. I would just like to thank our expert panelists for your time and your deep insight into this very evolving topic. So thank you. I hope this is the first of our conferences, because I expect we will reunite to explore this issue shortly.